go into the idea of time decay, time premium a little bit and how it all decays, and the 5 secrets of a great covered call. All right? I guess I could introduce myself, but it sounds like Tim had already done that, so no sense in doing that. So what is it? First off, a cover call is some combination of a long stock and a short call. What it does do, though, it allows you to be long, let's just say a little long, and still generate some sort of positive time decay. It gives you a little margin for error to be wrong on the downside, but as you'll see, and usually it's not near what the cash stake in the underlying is. And it actually helps you make a sell decision when you're having trouble. One of the things I do is just thinking about it, but the idea of a covered call is like, where do I want to get out? Especially if like sort of shorter term trades where you're trying to buy something on a bounce and you sell a call against it to get yourself out of the position. So basically, though, it's some combination of a long stock and a short call. We won't do anything. We won't talk about anything beyond that today. So no ratios or anything like that. Okay, so you got your stock. We'll use 3M back at some point in the past when it was a $97 number. Okay, I think everybody should be familiar with, well, maybe not, but this is just what stock looks like, right? You've got some break-even point. The underlying rips up, you make money. If the underlying rips down, like it did today a little bit, I wouldn't say ripped down, but definitely slid down a little, your long position isn't making you any money. Okay, so a cover call just stocks with a long stock position. Okay. To that, we add selling a call. So again, you get this little green area. So as long as when you sell a call, you stay kind of within the zone, somewhere below, let's say like looks like 99 or and change or something like that, and lower, you make money, right? So every day that goes by, hopefully you'll be collecting some money by selling a call. This particular case, we're selling a call at $1.63. So remember, when you sell an option, the most you're going to make is what you sell the option for. It's very hard to make more selling an option than what you sold it for. Okay, that's it. Much as we try sometimes. Now, you can put the two together. You put the two graphs together and kind of interpolate the results, and you get something that looks a little different, right? So you have the upside is truncated. So if the stock rips, you're going to make a little money. Not a lot, but a little. Okay. If the stock falls, okay, you're still positive until basically some point. So you have the solid line here is your expiration line, essentially, and the little tiny line here is your real-time line. So what you notice is even if the stock drops a little bit, and you let time pass, you will make a little bit more money as things decay a little bit more. That's all that says from kind of the real-time line, what they're calling your current, to the break-even, to your expiration graph line. Now the thing is we started with the stock at 97.29, and now our break-even line is somewhere below 96, around 95.66. Okay. So selling a call does help you out a little bit on the downside. Okay. It does not help you out a lot. It helps you out a little. Okay, so just from that point of view alone, okay, means that the overwhelming risk profile of the position, right, is a short put. Right? You make some money if the stock goes up, and you lose lots of money if the stock goes way, way down, and you lose money until the stock goes to zero. Okay, so call selling or covered call selling is basically what we'll call a synthetic short put. Okay, so all of the decisions that cause you to sell puts should be the same decisions that would cause you to enter into a buy rate. Now it's funny, a lot of you are probably looking at your 401ks and your IRAs and the market's up here. So these are some things to do where you really don't want to sell those stocks, but you might want to find some protection, so this will be a way to do that. But the decision ultimately is how do you trade a short put? How do you manage a short put position? What makes you put them on? So how we come at trying to solve the problem is solving the problem of a short put. Okay, so some of the stuff, right? You collect some premium on the trade, which lowers our cost basis on the stock. And that comes into managing as you go on. If you continue to roll calls against your stock position, you keep making it cheaper and cheaper and cheaper. Okay? You're limiting the upside because you're selling a call above the strike. So anytime you sell an option, right, you just think it's the premium plus the strike is essentially where the stock will be called away. So whatever you sell the option for plus the strike is where it gets called away. All right, I like this example here. It's like taking points on a football game rather than playing the money line. So you're not looking for, this is not a home run type of trade. It's a drip, drip, drip type of trade. Okay. So what you've done is you've developed a break even somewhere between 95.66 and north. Okay, where you can make money from 95.66 and then anywhere above that, depending on where the stock goes. So one of the things that was difficult, let's say in 2013, which actually is not so bad in 2014, is some kind of buy riding strategy when the market rips 30% in 1 year, which is a huge move. It's tough to basically try to maintain a buy ride strategy, but we'll look at how to do that. But on a year like in a year like this year, a buy ride strategy should do okay. So we'll look at an example of some of that stuff. Okay. So first off, what I try to do is is it worth it? Is it worth selling a call? Like I said, you just had a year where we're up 30%. Some stocks were up 90%. Okay, so what I want to figure out is just a quick and dirty way how to price. Essentially what we're doing is we're pricing the value of the synthetic put in the market relative to the underlying. So in our case, our example here, our stock price was 97.29. We have a strike price of 97.5, and we have an option premium of $1.63. So what we want to figure out is what's the return for us on doing that buy ride? If everything works perfectly in a perfect world, what do we get? So how you figure that out is you take the strike, you add to the option price, and you subtract the strike price. I'm sorry, the stock price. Okay? Then you divide that number, which should be a positive number, by 97.29, and what you'll get is what we'll call just the total return of the position. That's as good as it's going to be. 1.8% on a full margin, which means if you spent $9,729 for 100 shares of 3M, you're going to make a 1.8% return on your money for the carry. In this case, it was about 30 days. But if you do that times 12, you got 1.8%, and if you could come, even this is a simple interest, that's 21% a year. It's not too bad if everything is perfect. All right, almost 22%. If once you have compounding, it would be a little more. So the idea here really is, and that almost, right, that almost matched the S&P 500 last year in a record year. So the idea of a cover call is you're trying to make some money every month. It's not a home run, right? But it does give you what I like to say a little bit of room. It gives you a little room on the downside. It gives you a little room on the upside. Okay? What I shoot for, okay, and this is not a target, but this is a minimum. I don't bother with any trades, any kind of buy right type trades, or any short premium trades that don't generate at least 1% over a 30-day hold, which would be about 12% a year. And that's against full margin. That's my minimum. So if I'm selling puts, if I'm creating a buy right, whatever, when I'm trying to sell option premium, that's my minimum number. So what that does is it helps me set up kind of where the strike should be and what I'm thinking on the particular trade. Because an option premium might look pretty good, but then when you actually match it up to really what the margin cost is, the real cost of having your dollars tied up, it might not be that much. Remember, 1% is a minimum. I'd actually much prefer like 2% or more. And again, looking at a one-year period, all of a sudden, you know, you could do okay. Okay, especially if you're not, obviously you're not going to catch it every month. Stock will go down. There's repair strategies you can do with 1x2 spreads and things like that. Again, we won't get into that. But the idea is you want to start, you got to develop some sort of dollar basis or yield basis for this type of trade. It doesn't make any sense just to write calls willy-nilly without respect to what you're going to get for tying up your money in a trade like this. Okay, because it's not just like buying a stock where you have unlimited upside. Your duration and your yield is contained. All right, so the little simple arithmetic will help you decide what you're actually getting. Okay. Any kind of covered call can be done with any existing stock position. Okay. He's saying simply pick a call you want to sell against a stock you might own. But what I prefer to do is I like to be a little bit more systematic about it. I want to pick something that's going to be worth it for me. Something I feel I can start to outperform if this strategy, if I'm even slightly right about the underlying. So you just buy the stock, you sell a call, and it's a package. Okay, that's what a buy right is. All it is, it just becomes what they call a covered call trade. Covering means what they do is your stock actually covers the short call. Okay. But what we showed you at the beginning is that covered call is actually, from a risk point of view, a short call. Now, again, thinking about that, you've got an idea here about yield a little bit. You have an idea about really what the position is. So you have to think about to yourself, where do I go and sell a bunch of puts? That's the mentality. What makes me want to do that? Okay. So some simple mechanics first, right? If you don't get the stock call away, you just buy back the call and sell another option. Again, as long as it's working as far as, am I getting enough for the call I sell? Because don't forget, if you sell that call, you're giving away a lot of upside. If you're not getting something reasonable for what you're giving away, then it's not worth selling the call in the first place. Okay, buying it back for a nickel, okay, or less, and then selling another call, it's certainly fine. That's just rolling your short call out. It's done all the time. If the stock runs through the call, this is generally what we do. You let the stock get called away. And the reason is real simple. You want to make the trade a winner. You could easily make it a loser by covering the short call, rolling it, and you have to take the realized loss on the short call, and you're keeping the unrealized gain in the stock. Right? So if the stock falls down again, you're stuck with negative equity from the short call cover, and you're back to where you started with on the stock. So if the stock is going to get run through, just let it go. Okay? Take the fact that you're right and you made money, because if it runs through and you get called away, if you set it up properly, you should be outperforming. Again, like I said with the example there, you know, you're building in what you expect to make on the thing. Right? It's very hard for the market to do 2% per month every month. Right? 1% is still that, you know, what's the long-term average is only 7%, right? That's why I use 1% as the minimum number. Okay, for a buy rate. So you take a day or two and then you decide if you want to do it again, if you want to stay long the underlying. And that's a key part with this, if you want to stay long the underlying. Usually by not having the position on and letting yourself think about it a little bit, sometimes you're like, wow, I'm just glad I got taken out, and I'll move on to something else. Okay. So like I said, what is that ideal? That ideal is what the underlying creeps higher, but it's not skyrocketing. Because, right, you're just getting taken out for that little premium. Okay, as long as you consistently sell calls at higher and higher strike prices, it's great. Okay, you never have to lose your stock, and you actually get to keep the dividend. Okay, if the stock pays one. Perfect world. Now go back and you look at what stocks you own, how many are going to fit into that category. Okay, it's not easy. So this is a chart of option premium, how it works. So one of the things that we talk about is if you sell a call way out here, okay, that's going to help you with the cost basis of the trade. But as you move closer to expiration, it's going to decay a lot faster. So one of the big decisions you're going to make is, okay, if I sell the call way out there, I'm in this strictly for a, what I'll say like a midterm yield play. I'm going to sell that call for $2 or $3 or $4, and that'll be against the stock, and I'm just happy with that, and that's what I got. Usually what you want is, if you're doing something somewhere in the shorter term, you're more interested in trying to get the premium. Basically, you're trying to sell a call that you think is going out worthless, and the stock is just, like it says, covering what the short call position is. So the big decision is, do you want the faster decay in the near term or the longer term decay by selling an option a little bit farther out, knowing that it's going to decay slow here and fast here. So one thing you think about is, you know, where's the volatility of the option when you sell it? Because the volatility is relatively high. Let's say the VIX rate today is up a couple of points, right? Almost 2. It might be worth it to go a little bit farther out and a little higher out of the money when volatility is high, right? Because you can sell so much farther out of the money and generate a pretty good dollar. Right? When volatility is lower, in general, you want to be a little closer to the term, and the reason is lower volatility generally means the underlying isn't moving as much. So in a high vol environment, better to go farther out. In a low vol environment, better to go closer. Okay. So, right, so like we said, in 30 days, you see a huge increase in decay. And for reasons that we call the insurance effect, there's still plenty of decay with a week to go. Okay, mostly because options are so gamma sensitive. We don't really, I'm not going to talk about that now, but there's a lot of value in options that are relatively close to the money because just a little shake in the stock makes the options worth more. Okay. So as a new trader, or maybe some of you are old hands, you need to think hard about the duration. The easiest way I think about it is just I see what the volatility is doing in a particular name I care about. Okay, and I have an example too at the end here for something I'm looking at. And I'm doing some research. It's an idea. It's coalescing, let's say. As you become a better trader, you're going to end up adjusting the duration. To me, though, again, make it simple. The higher the vol is, the farther out of the money and in time you want to go. Generally, about 60 days is about as far as I'll go to sell something. The volatility is lower, you want to go in a little more, get a little closer. Okay, so here's an example, right, of just looking at premium and how much work it might be. Because Facebook, you know, it's been moving up, but tends to kind of lag between the earnings cycles a little bit. I think it's a pretty good stock to own. I own it. And I'm pretty aggressive writing calls against it because of this level. I've been along it for a while. If I get taken out at this point, I really don't care. So right now I've got the next week's like 73.5, so 74 is written against some stock, and I'm expecting to be taken out of it eventually. Okay, but let's look at looking at trading weekly 4 times versus just an ordinary SEP once. Okay. So when you look at the premium, if I just take, and I'm just making an assumption here, 74 cents, I'm just taking a near-term option, and I'm writing it once. Okay, and the next week you figure it'll be worth about 74 cents. Okay, all the way. You're not going to collect huge premium, obviously, if you're selling a weekly option. But you do have choices, right? So you can sell this 4 times for 74 cents and collect around $3. Or you could sell one SEP option, SEP 5 weekly option, which is this guy right here, for $2.40. Now the big difference for this month is, you know, you're selling the same strike, right? Relatively tight to the money, pretty good yield, not too bad, about 3%, a little more maybe. So that's not too bad for 1 month. 3% times 12 is 36%. It's pretty good. However, the difference between maybe chopping a week or 2 off means instead of just having to sell this 74, you know, the 74 level option, maybe next week you sell the 75 or the 76. You get the chance of, if you catch a little rally, you get to catch a little higher strike. And like I said, with the volatility in the low 20s, I'm doing things just on every 2-week basis. Not doing too much more than that because the vol's super cheap. Right now at 30 volatility, it's about the bottom of the range for Facebook. So what I think of is, again, notice how the August 16 volatility is around 30%. So that's how I think about it. Cheaper vol, I get a little closer to the money, and I sell it, and I'm happy if I get taken out. Again, it's still a great 2-week yield for money. Okay, the stock pulls back a little bit, I'll just be selling another call. I've got no problem with that. Now, for an example, like let's use Apple. This is something we grabbed from last year at the beginning, about mid part of the year, is just, you know, what does like a rolling strategy look like? So back when Apple was fun to trade, was in the 400s or 500s instead of the crappy $90 number that it is now. You actually got some, you know, 13.5, 14 3/4. You got, you know, there's, again, proportional, about the same premium, right? But when you compare just buying the stock over this time, it was about a 3-month period when Apple wasn't doing very much, right? You actually did okay writing calls, being relatively aggressive at the money versus the stock. Because again, you're still getting that 3%, 3%, 3% decent, you know, decent yielding numbers for the stock, and it adds up over 1 quarter, you know, to around 13%. I mean, if you can do that every quarter, you would never worry about, you know, that's obviously a great return. So one of the keys to successful buy writing obviously is, and that's what we'll see here at the end, is you've got to be real careful about the underlying you pick. Okay, some stocks make great buy-right stocks. Other stocks make awful buy-right stocks. So stocks right now I think would be similar, depending on the premium. Well, I've got some examples in here. I think Yahoo right now makes a pretty good one for a buy-right stock right now. Okay. So, first off, you also have to know who you are. So if you're a person that's going to buy a stock, and if it rips 25% and you have a call written against it, and you only end up with 3% return or 4% return or whatever it happens to be, or 2%, and you get all bitter and angry, buy writing is not going to be for you. Okay, I would suggest alternate strategies. You can sell put spreads and finance long calls, something like that. There's other things that you can do, right, to generate, you know, what I would say generate above average returns on an upside move without taking a lot of premium risk. But for people that are, you know, if you're more Peyton Manning-esque, where you're just trying to hit those singles all the time, might make sense. Okay. If you don't know what kind of trader or investor you are by now, you put on a couple of buy rights, and you're going to know within a few weeks what kind of a trader or investor you are. Absolutely, for sure. So what I would recommend is you have to do what's in your comfort zone. So I just want to talk about volatility a little bit, and let's just compare what a stock I think makes a good buy-right stock and one that makes a poor buy-right stock. So Amazon and IBM, okay? IBM is not a high flyer, but it's not going to zero either. It's trading at, what, 8 times earnings or something like that the last time I looked. It's not doing a whole lot, but there's enough dollar value in it, I think, to make a reasonable buy-right trade. It pays about $1 dividend. Yeah, it's trading at a 12 multiple of earnings. So it's not a stock that's going to go from 187 to 157 really fast, okay, which is kind of what you want. Okay. Amazon looks really intriguing because the volatility overall is a little higher. So we'll do a little sample of it. But it looks tempting. The problem with Amazon is, you know, it trades at a very high multiple. There's a lot of risk in a short foot with Amazon. IBM, there's risk, but it doesn't feel as catastrophic as it could be with Amazon. Because Amazon could still drop 25 or 30 bucks pretty easily. So there's a lot more volatility in Amazon in general than there is in IBM, right? So what does that look like? Well, here's how IBM trades, okay? Right now, the 20-day volatility, this little blue squiggly line, is around 14%, a little bit more than 14%. So on average, IBM moves a little less than 1% a day. Okay, the top 20-day volatility is right around 23% for IBM. Okay, now we'll contrast this with Amazon. The top 20-day volatility for Amazon is more like 50%. Okay. And really the low volatilities are only around 22%. So the thing with an Amazon is you're going to get a lot of back and forth. Okay, you're going to have a lot of excitement about your underlying position. You're going to run up, run down, right? As a trade, remember, if your buy right is essentially a short put trade, right? It's not that you can't buy right Amazon and it will work for a while. Of course it can. Any trade that you put on, anything you can think of can work for a while, easily. The problem is really, can you live with it? Right? I think there are other ways to trade Amazon, if you're interested, that are better than a buy right strategy. But what I want to do is contrast what basically a low volatility stock looks like and a high volatility stock. Okay. IBM is just going to sit here and just going to plod along. Right? Now, if you look at it, I'm just going to pull IBM up here. If you're just looking at it, if you're selling the 95s, 192, something like that, it's all right. It moves down a little bit, moves up a little bit, but the range is pretty dependable, and you collect the dividend. Okay. Suitable thing for like 401ks, IRAs, and things like that, where you don't have to really think or worry about it too much. You're just trying to generate a little bit more money than the S&P 500. Amazon, the ranges are so much bigger. If you're buy writing at 376 and now it's down like 25%, tough to make that work again with a buy right strategy. Okay, very hard. Unless you're really catching it at the bottom, it's a hard one. You got a lot more volatility, and it's just essentially it's a very, very hard stock to buy right. Okay, just flat out, I wouldn't recommend it as buy right. It's too difficult. Sometimes a strategy is not meant for a particular underlying, and that's what the idea is here. You really, if you're going to buy right, and I have clients at OptionPit that do it very well, like extraordinarily well, right? You really have to find the right vehicle for the strategy. A buy right is a strategy. Okay? If you're a buy and holder, that's a different strategy. Certainly works fine. But it's a type of strategy, and if you're a buy and holder, you're going to do that on a certain stock, right? Something you're pretty comfortable with. A buy right is a kind of a quasi buy and hold strategy. Okay, but it's not really a growth as far as growth in underlying price. So that you're really looking at a certain type of underlying. Right? So low vol, high vol. A low vol stock, they tend to generate better returns for buy rights. So stocks that pay dividends generally will have lower vol. Between yield from selling calls and dividends, that's not too bad. If you look at Microsoft and you look at Intel, you're actually generating pretty good money on stocks that that are going to have a hard time going down. This is not like a stock that can't go down, but when you compare it like to the risk of a CD or something like that, you're buying some Microsoft. I mean, how much are you going to lose relative to the amount of money you can generate in dividends and short calls? It all of a sudden doesn't look too bad. So one of the nice things is, right, normally a dividend stock will creep a little higher with some kind of increase in dividend. Generally, you just continue to add value that way. So another example, again, is your net price, what that takeout yield is. So if you're selling something here, so again, figuring out, using the formula I used before, so even a GE, and 15 cents is not a lot for an option, but it's really just more of, I'll sell the stock there if it gets there. Right, so using the same formula we had before, you take the option price, you add it to the strike price, you subtract the stock price, you'll get whatever your takeout yield is. Now, obviously, if you were buying GE and you could get 4.9% per month owning GE, you'd be thrilled. Right, but you collect the dividend, adds to the yield. So the next thing is, just like a buy right is a short put, you also have to sell calls where you're comfortable losing the underlying at that level. Basically, it's real simple. When you trade options, you have to want the position you end up with. If you can't stand the position you end up with, the stock moves way up or the stock moves way down, then the position is not for you. It's the easiest way to avoid trouble. If you don't ever have to worry about a margin call, you don't have to worry about closing a position. If you have to worry about a margin call, then you're going to have troubles with the position that you're picking. It's real simple. So if you're going to initiate cover call strategies, you have to think like that. If I sell the call, I can live with getting taken out at that price. I can also live with the underlying if it goes down, and that might offer me an opportunity to do something else. Sell more calls. But you've got to be a little bit strike-centric on what you're thinking about. Okay? So, if I sort of wrap up the end of this, so you're learning you're a little volatility sensitive, you're a little duration sensitive, you're underlying sensitive, you're position sensitive. It's a lot of stuff. Okay, if you want to be successful at it. This is even if you just buy the spot. You want to write calls on the spot. You're just like, okay, I want equity exposure. Same rules are going to apply, although for indexes they're a little different. Maybe we'll do an index, basically a protected index class for CTU, next month. But it's not just the premium that matters. Like I said, it's the overall volatility of the underlying. Okay, to really be successful with a covered call strategy, you need stocks that have relatively low volatility, not super high beta. Right? And what I want to remind you of is your covered call strategy is a short put strategy. Where would I sell a put? Right? With the market pulling back, it's starting to get a little more interesting now to me. Selling puts in the index. There's lots of ways to sell puts, but it's starting to look a little bit more interesting. You could actually get something for the 1800s now. Right? There's enough juice in it now to almost make it interesting. Okay, so here's some secrets, right? Again, just thinking of ways to put trades in your favor. I don't think I've gotten any questions yet. Oh, yeah, one question. Isn't that chart for at-the-money options? Sorry. Isn't that chart for at-the-money options? MK it is for at-the-money options. What about the transaction costs? Don't they reduce your yield? All transaction costs reduce your yield. But it shouldn't be by that much. If the transaction cost hugely affects your yield, then you have a problem. Then you need to find somewhere where the brokerage is cheaper. But I would definitely figure, like John with the 1%, you have to figure transaction costs with that. So the easy way is just after transaction costs. Okay? Hopefully that answers the question. And by the way, too, MK, the chart with at-the-money options, it's going to be at the money and near the money options. Okay? Your out-of-the-money stuff or way out-of-the-money stuff is going to have like more linear decay. One, only buy stocks that you are confident won't go down. And you're like, gee, Andrew, if I knew the stocks that wouldn't go down, that would make life a lot easier. However, what we're saying is, we're not saying stocks that will go up, we're saying stocks that really won't go down. They could be oil company stocks. They could be IBM. They could be Microsoft. They could be Intel. So to me, the great danger is not being called away. So, okay, well, I hope maybe I'll answer that question here in a second, buddy. But I'm going to say this simply for you. If you're buy writing a stock and you're worried about holding the stock, then it's the wrong stock. if you can't, let's just put it this way, if you can't want to own it, then it's a bad buy right candidate for you. So what I'm saying here with this as a strategy is it's incredibly selective. Okay, you're not always, there's no way you're going to be able to time the lows. However, a stock that is making lows should make it interesting to you. Right, I'll go through an example of that right now. But stocks that, right, stocks that won't go down anymore, generally the market already hates. So I've been looking at coal stocks. I've been looking at the online education sector, two areas that the market's been hating for a long time, right? And I'm just starting to look at some entry points for there. Right, because when I have a market at all-time highs and I have two sectors still at, you know, multi-year lows, I'm going to be interested. But I also have to be willing to own the underlying. Okay. Stocks that don't drop hard also don't move higher quickly. So stocks looking for bargains and a non-bargain. This is a we'll send you for people that want it. This is a whoops. Just trying to get the this oops. I was going to put this on a chat to everyone, but I don't see how to do that right now the way it's set up. So again, if you get the slide deck, I've got examples of all the, or a couple of our like more useful examples in our often blogs. Right. So one thing about buy rights is stocks that the market hates right now. I mean, look at Walgreens. They just got shredded on the fact that they're not going to, you know, they're not going to move their domicile outside the U.S. But the vol's a lot higher than normal right now. So if you want to buy it, I don't think it's too bad of an idea. Right? So secret two, again, lower vol stocks. Okay. And the reason why the lower the vol is, you're going to have lower premiums, but generally these are stocks that are not really going to move on you too much. Okay. This is actually a decent strategy too for ETFs, like index ETFs, sector ETFs. Okay, they can move, but if you can think of what the premium you're going to get for a, you know, a concerted strategy of selling, then all of a sudden it might be interesting. Another example here is Yahoo. Okay. Again, if you're going to get the slide deck, you can take a look at our blog or just go to the OptionPit blog, right, for that link. I have a position in this as well, doing basically what I just described here. So at OptionPit, generally, we put on the positions that we talk about. Okay. Stocks with a decent dividend stream. Right. Even again, stocks that pay relatively consistent dividends generally do not fall out of bed. Okay. If you're younger, put the dividend stream on a drip. Dividend reinvestment program, no problem. It's the easiest way I know to consistently, year over year, after owning stocks for, I don't know, Jesus, how old am I now? Like 30 years? You know, if you started buying stocks in 1985 or 1988, right? That's a ways ago. It's working out okay owning stock for that one, even though we've had, you know, the ups and downs that we've had. So, like I said, with the psychology part, especially to your question, buddy, is, you know, what are you trying to accomplish with the position? Are you trying to time the bottom by selling a put? Maybe a buy right's not the right thing for you. Maybe you need to sell just puts that are out of the money to give yourself more room, right? So remember, buy right is a specific strategy. Okay, it's very important that the underlying is able to maintain itself to some degree, right? Or it's just not going to work, right? Or the buy right's wrong for what you're looking at. Right? Last, you only buy right stocks you want to own. Okay, if you don't want to own them, right? So even you want to own them, and they need to be relatively low vol stocks. That's why I kind of like Facebook. It's been a great stock to own, and the vol's not too high. I just don't sell options around earnings on it. So that's the important thing. If you don't want to own it, don't write it. What are some pitfalls with selling calls against long hauls? I think the biggest pitfall is what you're paying. So are you saying, Peter, let's say you buy a January 2015 call, and then you sell some near-term calls, right? The biggest pitfall of that type of situation is having the stock run too much. So the short calls that you own against a longer term call kind of gets you bound up a little bit. You have to make sure that the underlying moves up enough, the position will be profitable enough for you to actually take off. Does that make sense, hopefully? That's the biggest one, because when you're trading a long call versus a short call, it's a gamma issue. You're short gamma near term and you're long volatility in the far term. When you're buy riding something, what you're trading is yield versus takeout. How much am I making if I get taken out? With the spread, when you have two different durations, if the stock rips up big, okay, you're going to make some money, hopefully, but you have to arrange it so if the stock really gaps, you're still able to unwind the position profitably. That's the biggest one. You have to think ahead. Because if the stock just drops back a little bit, your front month call goes out worthless, and then you just write another one against the one you're long. That's fine. You can find a call. But you use kind of the same idea. The problem is, though, is if it rips enough, are you selling a call out of the money enough to make it work? It's great to write stocks for company stocks that you might own. Okay? It's not a bad idea. But you don't want to sell calls in one account to be long restricted stock in another. That might be a problem. So you got to be careful. Right? Because your restricted stock is making money, except you're getting shellacked on the margin of the short option that you have. Don't do that. That becomes a problem. You only want to write calls against stock that you physically have possession of. Again, an Intel example of a stock you want to own from a bit ago. Last. Okay? If the premium is too cheap, there just might not be a call to sell. Remember the 1% rule. If you can't generate that dollar, forget it. Just keep your stock and wait. And when calls fall apart, it almost always makes sense to buy the call back. Almost always. And then get ready to write another one. Because remember, ultimately, you want to own the underlying. So this is something I'm looking at right now. Okay, we're talking about it in our chat before we go to our summary. I know this is an industry that's in terrible trouble, right? This educational services industry online, the administration hates it. These stocks are just getting totally killed. This was like not, January was $44 stock. Just having all kinds of troubles, just the government's attacking them, whatever, okay? So, like, all right, I'm about ready, right? I don't think this company's going away. I'm still doing a little more research on it. But at this point, I think I'll start writing at the money options against it. And the reason why is the yield is starting to get attractive to me. You know, you could sell an at the money option, August 8 calls, right? And you get almost 10%. Okay? That's not too bad. I could sell the SEP 8 calls for $1. Again, if I get taken out, fine. Or that puts me in the stock at $7. All right. I'll sell the 7 call against it next time. All right, so what I'm trying to do is, if I do this, you're trying to build enough room in the position. Hopefully everybody kind of sees that. So actually today I just tried to sell puts in here. They didn't take them. So tomorrow I'm going to buy stock and just sell calls. Screw it. Right? But this is an industry I think is just, it's having definite problems. I would say this is in its risk. This is like kind of more the risky part of my portfolio. I actually want to stick this in an IRA. But I also think it could make some dough. So those are, when I think about it, you know, when you're saying to Buddy, like, okay, the great danger is not being called away. So if you don't get called away, what's the next level? If you can live at the 7 and then you can write the 7 calls, you'll still be up money. See what I mean? If you mean you obviously cannot build unlimited amount. But at this point, unless the company just goes totally bankrupt, which I don't think it's going to do, because it has assets, right? But that's certainly interesting. You know, if I can make 10% a month every month, well, thrilled. All right, so that's something we're working on in OptionPit in our chat. Okay, we're looking at different types of ways to trade. I think that's ultimately just the best way is to write something against it. All right, so summary. Cover call is a way of taking some points to give up the money line. I think that's a good analogy. High flyers aren't good for cover calls. Okay? Actually, what the strategy I'm pointing to you here is actually this is like the risk. Fairly big risk, but I've been looking for an entry into this sector. So I figure I'll start with a 10% takeout. If they get me a little lower, and then I'll write something else. Okay, but I'm not worried about if I get taken out, and I feel I can hold the stock for a long time if I need to. Okay. Turtle stocks. Stocks like IBM, things like that. If you're going to write calls, that's the stocks you want to trade. Okay, and by understanding a little bit about volatility and duration, right, and what the position really is, right, you're selling puts. It's a put selling strategy. Don't forget that. All right, this is where we get to sell you stuff. Right. Most of how we talk about all option trading is similar to what we just did. I would say this is kind of what we'd say would be an introduction to a subject, cover call writing. Our boot camp talks mostly about the Greeks, how to use volatility, how to use vol with position management. Okay, how to allocate capital, things like that. Being smart about, you know, even just working with your IRA or something like that. But we're going to use options and we'll use Greeks and how that affects positions so you can understand how a position works. So it's about, I don't know, somewhere between 6 and 8 hours of instruction over a 3-day period, the 13th, 14th, and 2 sessions on Saturday the 16th. Okay, if you use code OA94, it'll be 147, and you can take an extra 25 bucks off that. Again, if you want to understand how to incorporate volatility and understand how volatility works, how volatility prices options, to help you with writing calls and kind of understanding what that means, what vol means, that's what we do in our boot camp. It's an introduction to how volatility is intertwined with the Greeks, with position management, with risk management, with capital allocation. All right? Any questions besides the 1, 2, 3, 4 that I've had? I think we're okay. Also, if you email me at andrew@optionpit.com, you say you're a CTU, you came into CTU and you're not already a client of OptionPit, you can try out our chat for free for a week. Let me know. Right, because we do a lot of education as well with trade selection. Okay, and we also keep track of all the trades that we actually look at. All right, any other questions? No? All right, everybody. Well, thanks for coming in. Greg, Tim, thanks for having me. And hopefully we will see you guys next month. We'll talk about a way to manage some index strategy, I think. All right? All right, Greg and Tim, I am signing off.